Welcome to today's explainer, where we're going to completely demystify SAP document splitting. We are going to take what is often seen as a complex, headache-inducing technical setting and transform it into a highly logical, automated hero for your financial reporting. If you've been working with SAP's New General Ledger for any amount of time, you know exactly how critical accurate segment reporting is. So today, we're going to make it easy. So let's kick things off with a massive pain point. Imagine you're holding a cumulative tax bill or a giant vendor balance, and you need to assign it cleanly across dozens, maybe even 100 different profit centers. And you need to do it without manually calculating every single line. Honestly, doing that by hand is a tedious, error-prone process that drains countless hours from your accounting team. Here is our roadmap for this explainer. We'll quickly cover the profit center problem, introduce document splitting, look at the core splitting concepts, witness the zero balance magic in action, and finally, walk through configuring SAP splitting rules. Okay, Section 1, the profit center problem, unbalanced reporting. We absolutely need to understand the underlying business problem first. Think about a completely standard vendor invoice. Your primary expenses are neatly assigned to their respective profit centers. For instance, expense 1 is $8,000, mapped perfectly to profit center X, and expense 2 is $2,000, mapped to profit center Y. But the cumulative vendor balance of negative $11,000 and the input tax of $1,000, those are left completely unassigned. Because of those blank fields, accurate segment reporting at the profit center level is literally impossible. Let's move right into Section 2. Enter document splitting, the 80-20 rule. This is where SAP's functionality steps in to fix this exact issue. It turns out we can apply a really simple, logical ratio to solve this cumulative balance problem. Because our initial expenses were split $8,000 to $2,000, the overall total, including the vendor account and input tax, should just automatically be split using that exact same 80-20 ratio. And that's the crucial takeaway here. If the system automatically handles that math for us, splitting the 11,000 vendor account into 8,800 and 2,200, and carving the tax into 800 and 200, your reporting is perfectly balanced. The manual workload is completely gone. All right, Section 3, core splitting concepts, the 3 pillars. To really understand how SAP pulls off this balanced state natively, we need to quickly define the 3 main mechanics of document splitting. First up is active splitting. This happens right as the document is posted, based on predefined rules set up in SAP ERP. The system actively looks at your expense ratios and applies them in real time. Second, we have passive splitting. You're mostly going to see this kick in during payment transactions. It simply follows the splitting ratio that was already established back on the original vendor invoice. It's essentially inheriting the logic passively. And finally, zero balancing splitting. Think of this as your ultimate fail-safe. If amounts simply cannot net off to zero for a specific profit center, SAP steps in and automatically generates a brand new line item just to force that balance. This is what guarantees absolute integrity in your reporting. Let's see this in action in Section 4, the Zero Balance Magic System Proof. We're going to step into the SAP GUI to look at a transaction and prove that this zero balancing trick really does happen. Imagine we're posting a standard journal entry via FB50. We've got 8,000 on both sides, but they are hitting entirely different cost centers and therefore different profit centers. The debit hits 1005 and the credit hits 1400. So in their own individual silos, they do not natively balance. But watch what happens when we simulate the general ledger view. SAP automatically generates a zero balance clearing account line to ensure each individual profit center nets to zero perfectly. It literally creates a credit for 1,005 and a debit for 1,400. It's a fantastic, fully automated mechanism constantly working behind the scenes. Which brings us to Section 5, configuring SAP splitting rules under the hood. The system handles the math beautifully, but how do we actually tell SAP to do it? Well, we are going to walk through the exact 6 configuration steps required in the back end to make this automation possible. We'll start at classifying GL accounts and go all the way through to final activation. Step 1 is classifying our general ledger accounts by item categories. Now, a huge best practice here is to assign these categories to a range of accounts, rather than doing it one by one. Trust me on this, setting up ranges will save you an immense amount of setup time during your implementation. Moving on to step 2, we assign business transactions and variants directly to our document types. This step is what ensures that almost every financial transaction is properly evaluated for splitting. You're basically mapping your standard invoices so the system always knows exactly when to apply the rules. Step 3 is absolutely vital. This is where we define the specific zero balance clearing account. For example, account 194500. This is the account the system will use when it simply cannot balance an entry on its own. It's the exact account we saw generated in our earlier simulation. Now, step 4 is arguably the most important configuration in the entire process. This is where we tell the system which specific characteristics to actually split on. We select Profit Center, and we make sure to check both the zero balance and the mandatory boxes. This is what forces SAP to strictly enforce your reporting dimensions without any exceptions. In step 5, we edit our constants. This acts as a fallback, default assignment. Say, setting the Profit Center to 9999. It's there just in case the system absolutely cannot derive the assignment from any other source. Think of it as a safety net so your postings go through smoothly instead of throwing up constant errors. And step 6 brings the whole shebang together. We activate document splitting globally and turn on the inheritance method. With inheritance on, non-assigned line items will just automatically derive their account assignment from other line items that are already present in the document. One final, very important technical note here. Even though you activate this globally at the client level, you can still maintain strict control by turning it off for specific company codes if you need to, like an entity such as IDAS AG, for instance. That gives you incredible granular flexibility across a really complex enterprise structure. So, considering everything we've just uncovered in this explainer, with the automated math of the 80-20 rule, and that bulletproof zero balancing safety net working for you, how much manual reconciliation time could this zero balancing automation save your team during your next month-end close?